Hello, this is Brad Harvey, and today's question that we're going to answer is, should I buy the dip? Well, let's start with what is a dip. Markets obviously move up and down, and you hear this a lot in the context of investing in the stock market in particular, but it can actually be true with other asset classes as well. The question is, if prices move down, and move down precipitously, should I be investing in those? Well, there's an old adage in the markets, and that is, don't try to grab a falling knife. What that really means is, when things are starting to go south, you don't necessarily want to go all in unless you have some confidence that the bottom has passed. Now, if you're a really long-term investor, you have 10, 15, 20, 30 years to go, this is retirement money, then buying the dip makes a lot of sense. Holding a lot of cash does not make sense, because there really hasn't been a 20 or 30 year period in the stock markets where you would have lost money from beginning to end. But when you look at buying the dip, it can be a very courageous choice. What I found in my career is that selling high is a whole lot easier than buying low, because selling high feels good. Hey, I bought something at $100, it's now worth $150, I sold it, I put an extra $50 in my pocket. But if the same investment you own, you paid $100 for, and now it's $50, and you say, wow, I want to put another $100 into that. Does that make sense? It takes a lot of courage. And you want to make sure that that's still something that you want to own, and own in increasing percentages. That's what we call dollar cost averaging. What that means is, over time, if you're buying in money over a fixed period, you should average prices lower than the overall price during the same time. Now, we can go through all the math if you'd like, but just suffice to say, essentially when prices go down, you're buying more shares with the same amount of money. If prices go up, you're buying fewer shares with the same amount of money. So the dollars stay fixed, but the number of shares that you pay and the price you pay per share does change over time. So should we buy the dip? Well, if everybody says, hey, we're in a real estate bubble, does it make you want to run out and buy real estate if you don't have to? Perhaps not. But if all of a sudden we're in a real estate recession and now you look in the newspaper and there's tons of foreclosures and lots of excess property on the market, that's when you want to be buying. It's called a value investor. You're trying to get more value for the money. Another good analogy is you're buying clothes that are out of season. A good time to buy bathing suits, in Colorado at least, is in the fall when the weather starts to turn cold. A bad time to buy it is in the spring when weather starts to turn warm. Well, obviously retailers know this, and if they have excess inventory at the end of the season, they tend to discount it, so you can go out and buy more for the same amount of money. So it can be a very sound strategy in investing to be buying the dip, if that makes sense for your long-term goals. Just pay attention. Know that what you're buying is what you want to own, and you want to own in greater percentages. And so remember, the only two prices that matter are the price you paid for something and the price you got when you sold it. Now, this can be a little bit more complicated if you're buying something for fixed income, but we'll leave that for another day. So today's question that we answered was, should I buy the dip? Thanks for visiting our channel. We hope you found the information valuable. If you want to see more videos about investing, please click to subscribe. If you have any questions you'd like for us to answer, please send us an email to harvey@riagroups.com. We would love your feedback.